With recent events like Silicon Valley Bank going bankrupt, is your money safe? Today I look at some different investor protections that are currently available. What sort of investor protections are available today? Which is better, SIPC or FDIC? FDIC was created by the Banking Act of 1933, enacted during the Great Depression to restore the American banking system. The FDIC is part of the U.S. federal government. Since its start in 1933, no depositor has ever lost a penny on FDIC-insured funds. That's a quote. Now, FDIC covers checking, savings, CDs. FDIC coverage is $250,000 per depositor per bank. FDIC does not cover stocks, bonds, contents of the safe deposit box, life insurance, annuities, or crypto. FDIC receives money from banks that pay into it based on total assets. Now, for investments, Congress passed the Securities Investor Protection Act that created the Securities Investor Protection Corporation, also known as SIPC, and that is a non-for-profit industry membership organization. It's not part of the U.S. government, unlike FDIC. It provides limited insurance for customers in cases where the brokerage firm defaults, becomes insolvent, or runs into a financial crisis. It also covers unauthorized trading. From its creation by Congress in 1970 through December 2017, SIPC advanced $2.8 billion in order to make possible the recovery of $138 billion in assets for an estimated 773,000 investors. SIPC protects against the loss of cash securities such as stocks and bonds held by a customer at financially troubled SIPC member brokerage firms. The limit of the protection is $500,000, which includes $250,000 limit for cash. SIPC covers stocks, bonds, cash, ETFs, mutual funds, CDs, puts, calls, and straddles. SIPC does not cover cryptocurrency or commodities. SIPC also covers unauthorized trading. SIPC coverage includes limited protection against unauthorized trading in customer security accounts. This coverage can include unauthorized trading by persons associated with the introducing firm and may be available even if the clearing firm, but not the introducing firm, is still solvent. However, SIPC requires victims to contact the broker in writing if an invalid or illegal trade is made. What are some of the cons of SIPC? There's actually quite a few cons compared to FIDC. SIPC is a non-for-profit funded by the same brokers it is supposed to protect against, versus the FDIC, which is part of the U.S. federal government. So definitely there's sort of a conflict of interest with SIPC versus the FDIC. Some companies have extended coverage, such as Fidelity. Extended coverage only gets applied after SIPC coverage is exhausted, which rarely occurs. So in the event that SIPC coverage is not exhausted, then the extended coverage will not get exhausted. So basically both of them are useless in that case. For example, Fidelity may provide its brokerage customers with excess of SIPC coverage. The excess coverage would only be used when the SIPC coverage is exhausted. The SIPC protection is limited. SIPC only protects the custody function of the broker-dealer. SIPC does not protect against the decline in value of your securities. It does not protect individuals who sold worthless stocks and other securities. It does not protect against losses due to a broker's bad investment advice or recommending inappropriate investments. Some of the Madoff victims reportedly had issues with SIPC, and some of them complained that they had not been paid by the SIPC because their assets were above the $250,000 limit, and they had withdrawn money in the past from Madoff. As a result of that, some of them claimed that they were victimized twice, first by Madoff and second by the SIPC. SIPC is rarely used and irrelevant. This is from a Wealthfront article that I found. This Wealthfront article was from 2013. It says the false comfort of SIPC insurance. They said, you might be surprised to learn that SIP insurance is quite irrelevant when it comes to asset protection. In fact, it has seldom been used over the 42 years it has been available. And that's sort of, if we go back and look at the data, from 1970 to 2017, SIPC advanced only $2.8 billion to make possible the recovery of $138.7 billion. That's for 773,000 investors. So that doesn't sound like a whole lot over that period of time. When a brokerage firm is closed due to bankruptcy or other financial difficulties and the client assets are missing, SIPC steps in to help return clients' cash, stock, and other securities. It only steps in when the firm shuts down due to financial circumstances in which customer assets are missing. Okay, so now what this states to me is basically fraud. They would only step in with fraud because if the client assets are supposed to be in a separate account from the operating account, then the client's assets should not be missing unless they're misappropriated, I would guess. In such circumstances, SIP provides up to $500,000 of protection on securities per legal entity and up to $250,000 in cash, in excess of what is not recovered. Limited partnerships. There's a lot of publicly traded limited partnerships. Investment contracts and limited partnerships and fixed annuity contracts are also not available for SIPC protection. SIPC reports that 99.7% of eligible investors have been made whole in the 324 cases of failed brokerage firms that it has handled since its founding 42 years ago. SIPC reports 99.7% of eligible investors have been made whole in the 324 cases of failed brokerage firms that it has handled since its founding 42 years ago. So that's roughly 8 cases per year, more than I actually thought. But I guess that's not a whole lot of work to do on a 9-to-5 basis, 365 days a year, that they would only have 8 a year, and probably most of those are smaller. Of more than the 625,000 individual entity claims completed or substantially completed as of 2011, 351 remained unsatisfied for claims of cash and securities whose value was greater than the limits of protection afforded by the SIPC. These claims total $47.2 million and represent less than 0.06% of all claims made. So in conclusion, what are my thoughts on the FDIC versus SIPC? Which one is better? And does SIPC do a good enough job? Between the two of them, FDIC is definitely the better of the two. FDIC has had a longer track record. They've had just since 2009, there's been 513 U.S. bank failures that they've protected investors from losing all their money. FDIC steps up much sooner. FDIC steps up more often than the SIPC does. They have more authority, and they're less reluctant. So I would say SIPC is basically like the reluctant referee or the reluctant administrator, whereas the FDIC is basically like the savior. So you're talking about a reluctant referee versus a savior. I would choose the savior over the reluctant referee. And so that's what I think about that. But what sort of investor protections are in place? So besides the SIPC, what sort of investor protections are in place? Well, first, there's a thing called the net capital rule. Part of the U.S. Exchange Commission, SEC, makes it mandatory for brokerages to maintain minimum capital in liquid form. Then there's also the customer protection rule, which requires brokerages to keep client assets, both cash and securities, in a separate account from the firm's assets. Brokerages are also required to be members of the SIPC. So even though SIPC isn't as good as FDIC, it's still better than nothing. And it's better than the option of not investing in stocks, which would be far worse in the long term than the small risk of a loss from a brokerage account. Over the long term, you would lose a huge amount of money by not investing in the stock market. So I definitely think it's still worth investing. And with all the security in place for the brokerage accounts, now the SIPC doesn't cover against hacking. However, there's lots of security mechanisms in place. Brokerages have lots of security in place now where you get emailed whenever a change is made to the account, or you get sent a text message. You can get emails for all the trade confirmation. So if anything weird starts happening, you'll get notification and you could contact the broker and let them know something weird is happening. So that's better than nothing. That's pretty much all you can do for that, as far as without having some type of other insurance for that. So anyways, I hope you liked this video. Make sure to like and subscribe. It really helps the channel out.